Live from Singapore, this is Insight with me, Haslinda Amin, a show where we dive deeper into the stories that matter with crucial context and sharp analysis. Asian stocks and U.S. futures drop after Nvidia reveals new U.S. restrictions on its chip exports to China. President Trump also moving towards adding duties on critical mineral imports. China's economy expanded at a faster pace than anticipated in the first quarter of 2025, but that was before the tariff turmoil, and now the outlook is rapidly worsening. And we'll speak to a political scientist and China expert Scott Kennedy about why Beijing thinks it can win the trade war with the U.S. Our top story today, investors on edge as tensions between the U.S. and China escalate further. Traders were whiplashed by news that the U.S. is putting new restrictions on Nvidia's chip exports to China and moving towards tariffs on critical mineral imports. The White House is putting the onus on Beijing to resolve the trade spat, calling on President Xi Jinping to pick up the phone.
I do have an additional statement that he just shared with me in the Oval Office. The ball is in China's court. China needs to make a deal with us. We don't have to make a deal with them. There's no difference between China and any other country except they are much larger. And China wants what we have, what every country wants, what we have, the American consumer. Or to put it another way, they need our money.
But a former top Chinese economic official says Beijing is unlikely to accept Washington's conditions lying down. Zhu Guangyao told us exclusively that China will only engage in talks if the U.S. show some respect.
U.S. wants China totally accept the U.S. proposal. To accept U.S. conditionality, I think there's no negotiation, and must be under the mutual respect and with this joint win-win situation.
And we'll have more from my exclusive interview with former Chinese Deputy Finance Minister Zhu Guangyao later on in the show. Let's take a look at how Asian Nvidia suppliers are doing on the back of the additional tariffs on Nvidia, especially that H20 chips, which has been pretty essential for China. SK Hynix in negative territory, down by 2.8%. Losses too for the likes of Samsung Electronics, Taiwan Semiconductor, and Hyundai, currently down by more than 2%. That limit on China's exports to cost Nvidia $5.5 billion. Of course, we saw how that played on Nvidia shares, in particular, losses for the stock. We're also keeping an eye on those minerals, rare earth stocks, the likes of Paladin Energy, currently in negative territory, but gains for the likes of Lynas Rare Earths, China Minmetal, and China Northern Rare Earth. Of course, this is one area which China is dominating, much to Trump's ire, of course. Now, speaking of rare earths, Malaysia, one of the key countries caught in the crossfire between the U.S. and China's trade conflict. The Southeast Asian nation is a hub for chip manufacturing, also a key producer of rare earths. Chinese President Xi Jinping is there right now, urging Malaysia to work with Beijing to protect supply chain stability. Bloomberg's own Avril Hong is in Putrajaya for us. Avril, a lot at stake for both leaders.
Absolutely. I mean, you're hearing today, right, how China is trying to show up domestic growth with an action plan. At the same time, it is trying to show up global supply chains. The Chinese leader in coming to the Southeast Asian region, Malaysia, second leg of the tour. And this is only the second time in more than a decade that he's actually visited Malaysia. So you can just tell the optics. There is a lot at stake here. And keep in mind, when we first got wind of this visit by the Chinese president to the region was in late March. And at the time, it was kind of touted as a way for China to show its clout in the region. Since the tariff announcements from April 2nd, it's really kind of pivoted into a way for the Chinese leader to try and convince Southeast Asian countries that they shouldn't be cutting trade deals or tariff-related deals with Washington at the expense of Beijing. And amid all this, also a chance for him to promote China as a more stable partner than the US. Now, Malaysia also has a lot at stake here. You remember how when it comes to trading partners, China is still the top of the list, its biggest trading partner. And indeed, trade between both sides, just last year, the value exceeded $100 billion. For Malaysia, it's a very fine balancing act, of course. As it's negotiating with Washington, it also needs to come across as friendly to China, and indeed has been rolling out the red carpet for the Chinese leader on the way from Kuala Lumpur, the capital, to Putrajaya, the administrative capital, where, of course, just a day ago, the Chinese leader landed in KL. We saw all these banners and billboards that really showcase the warm welcome for the Chinese leader. And if you can see behind me as well, it is a hive of activity, preparations at this complex, the official residence for Prime Minister Anwar, and really just preparing the stage for the Chinese leader. So a lot that we're keeping an eye on, especially given the expectations of MOUs between the two sides to come.
Also, just to put it some context there, Avril, Southeast Asian nations among the countries slapped with among the highest tariffs by the U.S. Vietnam in particular, 46%, and Malaysia in excess of 26%. Now, we know chips, commodities, the key focus here. What's in play?
Absolutely. I mean, you raise a really good point, right? It's no small coincidence that the two countries that are also part of Xi's tour, Vietnam, Cambodia, were slapped with the highest tariffs from the U.S. for this part of the world. And you keep in mind as well that how chips, commodities, they are really figuring high in the equation in U.S.-China rivalry. Think about these China chip restrictions, but also the announcement of this probe into critical minerals. And you see how rare earths, they are also a key commodity for Malaysia. It has a lot of it, but it's still kind of reliant for the Chinese technology in processing these rare earths. And on top of that, when it comes to the tech sphere, think about how data center investments from China in Malaysia have been building, gaining steam over the years, and its prominence as well as a massive player in low-end semiconductors. So that's the context, that's the subtext as well, that these discussions between the two leaders are kind of taking place under.
That's right. Malaysia benefiting from China Plus One. Now it is in the crosshairs of U.S.-China tensions. Avril Hong from Putrajaya, we thank you so much for joining us. Well, our next guest is a leading authority on Chinese economic policy and U.S.-China commercial relations and has been traveling to China close to 40 years. Scott Kennedy is senior advisor and trustee chair in Chinese business and economics at the Center for Strategic and International Studies. Thank you for joining us, Scott. Put this in perspective for us. We see China digging its heels, almost ready for the long game. Why such confidence?
Well, China wouldn't have done this if the U.S. hadn't imposed so many tariffs on them in the first Trump administration, the fentanyl tariffs, and then the reciprocal tariffs. I think the Chinese are showing some confidence because over the last several years, they've been able to expand their capacity and abilities in technology. They have still a lot of fiscal room left for a stimulus to counter the fall that's going to happen from a drop in exports to the United States. They have a lot of countries around the world that depend on them for trade and investment. And Xi Jinping's trip to Southeast Asia, as you pointed out, is trying to solidify and expand those relations so that China avoids being isolated. Also, some of the problems of China's economy actually work to its advantage. China's financial markets are pretty small, only about 60% of GDP. The United States financial markets about 140% of GDP. So when U.S. markets went down, that was a huge hit on the American economy. China's financial markets can go down some, and they can get away with it. And I think just the last thing is resolve. For this conflict, for China, it's existential. For Trump, this is a trade war to show that he's powerful. But this isn't an existential fight for the United States. This is a war of choice for Washington.
Scott, isn't it also about standing up to the U.S., whom the Chinese has termed as a bully? I mean, China is, after all, the second largest economy in the world. And in my conversation with the Vice Minister of Finance, the former Vice Minister of Finance, he did say about, China unwilling to come to the table for negotiations unless it is shown some respect.
Sure. Well, if you remember in the first Trump administration, the pressure and the tariffs and the concessions were all in one direction, from Beijing to Washington. And I think the Chinese decided that they wouldn't go through that again. And now that they've been singled out relative to everybody else, they're definitely going to stand their ground. I don't think that this is just strictly about respect. I think it's also about China's economic future and the rules of the international system. So I think whether it's about respect or about their belief that they can withstand this longer than the U.S., I think we're in for a significant fight.
You talk about how this is about China's future. China has its own issues. Yes, its economy is slowing down, but there are other big issues as well, like corruption, widespread corruption, political purges. These are barriers to its own development. I mean, how confident can it be when it is facing multiple huge issues? Sure.
China's facing a lot of headwinds. The pandemic was, and since the pandemic, growth has not been high. There's the business confidence, consumer confidence is low. There's a lot of governance challenges, and the Chinese aren't sure how this is going to turn out. But one of the things that's really interesting about this is a lot of the pressure that's coming from Washington and others, pointing to China's very large global trade surplus, which was over $1 trillion last year, is pushing the Chinese to reconsider much more seriously the need for structural reform of their economy, to shift from depending on high-tech exports to domestic household consumption. That would be good for China in its own self-interest. It would also relieve some of the trade tensions that they have with others around the world, including Washington. So I think actually there is a potential landing zone for Washington and Beijing and others for eventually. We're not near that yet, but you can see a possibility of a potential deal.
But what would it take for an off-ramp?
Yeah, well, I think first, both sides are going to need to feel enough pain that they feel that they must come to the table, not that it's something that they'd like to do. And as we've seen from Washington, the Trump administration says that they're not feeling pain, despite the huge drop in markets last week. China's first quarter numbers just came out stronger than expected, though depending heavily on exports, private investment grew barely at all. So we can expect in quarter 2 and 3, China's numbers are going to probably go down significantly as their exports to the U.S. tail off. And then you're going to have to see where they're willing to compromise. It's going to be about exports and trade. Is it going to be about the exchange rate? It's going to be about investment. TikTok might be on the table. There's a lot of different issues that they could discuss. And at some point, not right now, not next week, they will try and figure out, they will pick up the phone and they will figure out how to sit down.
Scott, you talk about how China's tech breakthroughs giving it the confidence for the future. Break that down for us. We know that DeepSeek has, been able to do AI at a lower cost, but it's not so much that. It is the fact that it is open source that actually gives it the confidence that there can be more innovation in this country of 1.4 billion people.
Sure. This is hard dollars and cents and tech issues, not just strictly informal confidence. So going to China over the years, I've watched their technology capabilities grow dramatically. For many years, Chinese companies were just partners in auto companies that were really run by their foreign partners. Now Chinese are world-class automakers themselves, in many ways ahead of their Western competitors. in information technology and devices, from cell phones to pads to all different things. The Chinese have done a lot better. In semiconductors, where the U.S. restrictions have been the greatest, the Chinese are beginning to make some headway in even some of the most advanced chips and equipment. And so they have some staying power. So it's going to be very difficult for the West to impose some kind of technology boycott and crater China's economy the way they might have before. The place where the U.S. still has not gone, and where China has not gone, is in the financial world. Restrictions on Chinese financial institutions, access to the dollar. That would turn the problems into those with the B, billions, into those with a T. But that could invite tremendous blowback on the American economy as well. So for the moment, it doesn't look like they're going in that direction, although they could if need be.
I want to delve slightly deeper into the democratization of AI, which is what we're seeing in China right now. We had DeepSeek, we have Manus. Where does it go from here?
So, the AI world has originally been a world of global R&D. Microsoft, other American companies with labs in China actually were the source of China's original AI entrepreneurs that are so famous today. American AI companies have turned toward proprietary solutions. The Chinese, facing those kind of restrictions, ironically have moved in the open source direction and looked for ways to deal with these kinds of restrictions, and in some ways have been very successful. The Chinese have also been amazingly successful at applying AI to cars, smartphones, medicine, manufacturing, in a way that we've not seen with others. And so the strengths and weaknesses that the US and China have in AI are asymmetric. They're both going to be AI powers. And I think even though they both have tremendous capabilities separately, they actually are going to depend on each other to continue to grow AI, and also to build the rules and norms to make sure AI is primarily used for good and not for bad purposes.
And Scott, even as we talk about how China currently is on the receiving end, how are you making sense of how the U.S. is looking at it? I mean, why is Trump and the U.S. trying to unravel a multilateral trading system that has been so beneficial to its own country, has made its country rich?
Sure. In general, I think you're absolutely right that over the last 50 to 70 years, the American economy has blossomed and prospered because, in part, of connectivity with the rest of the world. But those benefits have been very unevenly shared in the United States. The two coasts have done a lot better than the central part of the United States, and manufacturing workers have not done as well as those in services. And the U.S. has not provided a lot of support for worker retraining and to make the economy more beneficial for others. And so the U.S., and like many other places, is rethinking its relationship with globalization. Trump is the latest incarnation of that. And in their mind, trade deficits represent losses. And so they decided that it'd be better to blow up the international trading system than try to tinker with it. They obviously felt the results of those themselves last week and adjusted, and are now on plan B or perhaps plan C. That's just, at least what that's done is at least got everyone's attention. So there are challenges in how the economic system is designed. There is reform that is needed. Even the Chinese say that global economic institutions need to be reformed, but exactly how they should be is going to be up for debate over the next few months as they negotiate and try and find an off-ramp to this crisis. But it's also going to be with us for a long time, figuring out what is the WTO going to do, what will the role of CPTPP and RCEP be in Asia and beyond. These are all huge questions for which we don't have clear answers right now.
Well, another huge question is whether it makes sense to bring manufacturing back to the U.S. I mean, there's some misconception out there that, companies go to China because of cheap labor, but labor in China has stopped being cheap for years now. It's really about skilled labor. Some say that only Chinese workers can do, not the Americans. And I think that's something that's been voiced by even Apple CEO.
Sure. I think in a world where there are not major geostrategic tensions, globalization and the pursuit of efficiency make total sense. But when you have geostrategic tensions intersect with globalization, then you have challenges like pandemics, climate change, resilience is really important, and having your own capabilities are as well. And so it's not unsurprising that the U.S. would want to increase manufacturing somewhat relative to services. There are now about 13 million people who work in manufacturing in the United States compared to 140 million in services. That's quite a shift from where the U.S. used to be. But the U.S. can try and modify that ratio some, but they're going to continue to depend on the rest of the world, China included. So I don't think we should discount that the U.S. has a right, if it wants, to try and expand manufacturing, that it could strengthen its abilities in other parts of the economy. But that doesn't mean that it can act all alone in a castle without collaboration with others. That is very far-fetched.
Right. Scott, I know that you've been going to China for decades now. What's the mood on the ground right now? Is there a sense that the people are backing Xi Jinping and pushing back on the U.S.?
As I mentioned before, China's economy has really struggled the past few years. China's political atmosphere has gotten a lot tighter. Its relations with the rest of the world have worsened. The fears about a potential cross-strait conflict have risen, and that soured public confidence in China. But when I was there just last month, even without a huge improvement in the economy, there's been a sea change in attitude, in part because folks look across the Pacific at the United States and really have a hard time understanding why the U.S. is doing what it is doing. It's political tensions, changes of fundamental policy about the U.S.'s role in the world, attacks on political institutions. These really weigh on people's consciences, and they look at their own country, and although maybe not perfectly happy with it, say, well, at least we're stable, we're predictable, and we don't like being hit with 145% tariffs. And so even between hawks and liberals in China all think that China needs to defend itself. They don't know what the ultimate solution for China should be, but they're ready to push back on Washington right now.
Scott, great insight. Scott Kennedy of the Center for Strategic and International Studies. Thank you so much for joining us today. Now, we have that China data dump slightly earlier this morning. All data coming in better than expected. We had GDP coming in at 5.4%. Retail sales and industrial output is also stronger than anticipated. Bear in mind, though, that this data has come in before that 145% tariffs imposed on China. People are expecting that impact to be seen in the next data numbers. Q1 GDP coming in at 5.4%. The estimate was for 5.2%. Industrial production 7.7% versus 5.9%. Estimates and retail sales also improving, up by almost 6%. Expectations were 4.3%. And China's property market also has a big room to grow, according to the National Bureau of Statistics. Now, still ahead, Societe Generale will be joining us for more insight on China's economy, on the measures Beijing is taking to boost consumption. Keep it here with us. This is Bloomberg. We're keeping an eye on Asian currencies, the yuan in particular. Of course, PBOC keeping an easing bias on the currency as the economy struggles to gain traction. We have the Chinese yuan trading at 733.31, down about 0.6% versus the USD. Coming up, our exclusive interview with the former Chinese Deputy Finance Minister Zhu Guangyao. Keep it here with us. This is Bloomberg. Welcome back. You're watching Insight. Former Chinese Deputy Finance Minister Zhu Guangyao says Beijing has full confidence in meeting its growth target of around 5% this year. That's despite risks from the escalating trade war. Zhao also told us exclusively about President Xi's main principles for dealing with Washington.
I think for this specific negotiation should be based on real instruction by two presidents. President Xi highly emphasized the relation with the United States. President Xi always emphasized based on three principles: mutual respect, coexist, and win-win situation to develop a healthy, stable, and sustainable relationship with the U.S. That's China's policy. That's President Xi gave clear instruction to all level of Chinese staffs. That's based on that. I was before to deal with the U.S. in economic. We fully respect the U.S. We fully follow the instruction by President Xi Jinping. We do everything, maintain the healthy, stable, and sustainable relation with the U.S. But this time, again, we must take action, retaliate, because that's, we don't want the whole world return to the jungle of jungle law.
So just to be clear, right now, the two sides are not on speaking terms. Officials on two sides are not discussing possible solutions to the trade war. Is that correct?
That's subject to how do you define that. If that's U.S. want China totally accept the U.S. proposal, to accept U.S. conditionality, I think that's no negotiation, and must be under the mutual respect and with this joint win-win situation.
What does mutual respect look like? Would the U.S. have to reduce the tariffs to 85%, 60% to bring President Xi Jinping to negotiations?
I know in U.S. team always think the President Trump is the top negotiators. Art of Deal, the book written by President Trump, and let's do business. Now it's country-to-country relations. We should exactly follow the rule of WTO to deal with bilateral trade dispute rather than to use just pressure. Since People's Republic of China founded, China never yield to outside pressure. So that's why I hope real negotiation for trade imbalance issue should be based on mutual respect, not just use as pressure and let this other side accept all conditionality raised by U.S. That's impossible.
Mr. Zhou, what's the impact of the tariffs on China's GDP? Currently, the target is around 5%. We've seen a lot of downgrades in terms of projections. How confident are you can achieve the target of around 5%?
We have full confidence to achieve the economic development goal this year, around 5%. This year is very important for China. This year is the last year of Chinese 14th five-year program. We have the 2035 perspective. That times build China into basically modernize the socialist country.
What will drive growth? What will get you to close to 5%? You take a look at exports. Yes, the number was very strong for March, but that was front-loading. You need consumption to drive growth going forward, and consumption is weak.
You are right. Chinese market is a super large market. We have 1.4 trillion people. We have more than 300 million middle class.
But 1.4 billion people are not spending to drive the economy.
But no, we have this fundamental change, and we encourage people spending and expansion domestic consumption. We have full confidence that domestic consumption will be increased, and with this productivity enhanced, with this technology development, particularly digital economy. Last year, our digital economy to the total capacity of economy is already more than 44.6%. This year,
if you are expected to spend 10 trillion yuan, do you have the capacity to spend to boost consumption?
for central physical capacity, we have a large room, but we also, to be honest, we also should deal some challenge, local government debt issue. So that's why several months ago we took action, increase 14.3 trillion renminbi to deal with the local government debt issue. And that's, we do action already, and we hope such kind of result can strongly support Chinese economic development. And we also hope we continue to contribute to global growth. And since 2009 or 2010, from that year, Chinese every year contribute to new growth of global GDP is more than 30%. I think that's, we should do that, but the world should understand this. And in my personal view, and this demonstrates global cooperation become more important.
Mr. Zhu, when you take a look at the markets, there's a lot of concern about China possibly selling off its holdings in treasuries. Has China done that? Would China do that? Has it ever considered dumping U.S. treasuries?
In my working experience, we have very close communication with staff of U.S. Treasury. I understand very well the U.S. Treasury careful very much about the yield and about price of U.S. government bond. And now, if that's 10 years, U.S. government bond is more than 4.5%. I think, frankly, that's big pressure for U.S. government spending, because last year, 2024, your U.S. government bond interest payment is 1.12 trillion U.S. dollar, and U.S. trade deficit is 1.2 trillion dollar. That's 2 more trillions. I understand that should take action to correct, but correct action not use the way of reciprocal tariff.
Would China consider dumping and selling U.S. treasuries to counter the trade war?
I can tell you, I used to be in the press conference said very clear that the Chinese investor, Chinese government as very responsible investors, we understand how important of global market stability. However, this is based on mutual understanding, mutual respect, and mutual cooperation. I really hope U.S. and China can, based on mutual respect, return to negotiation to solve the problem each side concerned.
I want to touch on the Chinese yuan. We've seen the daily fixes being weaker than anticipated by the market. Are we seeing the signs, the beginning of the signs of a devaluation of the currency?
And the Chinese yuan and our renminbi policy is very clear. It's relatively stable. It's our real driven policy. And you can see recent weeks, even this big market turbulence, but renminbi yuan keep this relative stable. Even that's 7.3 up and down, and that's market fluctuation. But in general, we see the relative stable policy is our policy.
Some say 7.5.
7.5, 7.3, and that's a small fluctuation because we have the central level price, and People's Bank keep that very careful to manage this band, and that's why we have full confidence. Even this big turbulence of international market, renminbi will keep relative stability, and China will contribute to the global market stability.
And that was former Chinese Deputy Finance Minister Zhu Guangyao speaking exclusively to Bloomberg. And we have a couple of headlines to tell you about. President Donald Trump taking to Truth Social to say that the U.S. is taking in record numbers in tariffs, with the cost of almost all products going down, including gasoline, groceries, and just about everything else. He says, likewise, he says, inflation is down. Promises made, promises kept, according to the president. Again, President Trump taking on Truth Social, saying that the cost of almost all products in the U.S. are going down. Inflation, he says, is down. Taking a look where we are in terms of Chinese assets on the back of NVIDIA getting slapped with additional and tighter restrictions on its chip exports. We're seeing CSI 300 index currently down by about 1%. Hang Seng, a bigger decline by about 2.5%. And in terms of the Chinese yuan, 733.29, we saw a weaker than anticipated fixing by the PBOC. Of course, we're seeing a gradual depreciation of that currency to perhaps reflect the weakness in its economy. And again, China March industrial retail sales topping estimates, with GDP coming in stronger than anticipated. But that data coming in before that 145% tariffs being implemented by the U.S. Consumption is key, and that is what the Chinese government is expected to focus on going forward. Now let's get reaction to China's latest economic data with Wei Yao, head of research and chief economist for APAC at Societe Generale. Wei, give us a sense of the numbers that we saw today. We know that it is before the tariffs came into play. Is this the best we're going to see? Is it going to be a slide from here on?
Well, so obviously, I think Q2 will take a hit. I think that's inevitable with all the U.S. tariffs. The economy did well. There was in Q1, there was front loading, there was policy helping, but now we definitely need more policy support to cushion some of the trade pain in the Q2, starting from Q2, yeah.
How much policy support? Some say fiscal stimulus is key at this point. It is not just about monetary policy, and the numbers being thrown around ranges from 2 trillion yuan to 10 trillion yuan.
Okay, so we just actually revised on our GDP forecast from previously 4.7% to 4%, and that's with the assumption that the Chinese government will be willing to deliver additional fiscal stimulus to the tune of 3 trillion of RMB. Of course, if they are willing to do more, that would be better. But when you look at China's strategy, right? So they decide not to back down on the tariffs, which is only logical to expect that they're going to step up the fiscal stimulus. So we do think they at least would deliver some meaningful amount to cushion part of the pain.
Your assumption is that the GDP will get to 4%. China's assumption is close to 5%. What will it take for it to get to close to 5%? How much stimulus is needed for that?
Well, to get to 5%, they need to do more. Of course, before that, there is a question, whether we will get some more kind of tariff exemptions. It is likely, but it's uncertain. On the stimulus front, the obvious things they need to top up is, one, definitely a lot more on the consumption. Second, they really need to do a lot more in terms of stabilizing the housing sector. So all the options they were thinking, but it was going slowly, like, removing stocks from the market to stabilize the housing sector and all that, they now all have to speed up significantly.
So fair to say we've seen the worst of consumption, seen the worst for the property sector. We're seeing, the pace of decrease in terms of home prices easing somewhat as well.
No, I think, in the very short term, there's still going to be a hit, right? Then it's a matter of, how much stimulus they're willing to provide. If they do deliver, then things can start to stabilize and get better, maybe towards the end of the year or second half. but they have to do that. They have to do it now. Yeah.
What do you see the PBOC doing?
I think to PBOC, right, of course, they could cut interest rates or triple R, but the more important things is one, how they're going to manage the currency. We are of the view, some depreciation against the US dollar is likely, but not significant so, because, too much depreciation could also be negative for the domestic confidence. And the second for the PBOC is how they manage the bond yields, right, which is essentially a kind of extension of their job on managing interest rates, broadly speaking, because the bond issuance is definitely going to shoot up from here if they follow up with fiscal stimulus. So in a way that we're sort of expecting the PBOC to more actively managing the bond yields and the curve.
Let's pick up on how it's managing the currency. The yuan is down 8% versus the euro, about 6%, I think, versus the USD. We've seen a gradual depreciation of the currency. Is the PBOC managing the depreciation well? It's been pretty stable on the downside.
Right, indeed. So far, so good. Given that indeed the U.S. after all levied this very high level of tariff on China, the pressure is on the currency to depreciate even more. But given how stable it is, I think they're doing a pretty decent job. But we're just at the beginning of seeing some effects from the tariff. There could be more happening, and I don't think the pressure is over or off very quickly.
So how much more depreciation in the currency is needed without triggering the kind of response we saw back in 2015 when the devaluation of the currency prompted a sell-off in Chinese assets?
It's, one, definitely, they shouldn't do one-off devaluation, large size, and we don't expect them to do. It's not a good choice for them. Second, talking about depreciation, right? It's I think less than 5% is probably tolerable. More than 5%, it could become tricky. But it's a very fluid situation at the moment, so we need to see.
Wei, we know that China is trying to change the way it drives growth in the country. It's now consumption-driven, but this is a model that takes a very long time. What do you see driving growth in the next 4 years within the Trump administration's purview, I suppose? I mean, what can be expected in China's growth story in the next 4 years?
I think now they are left basically with no choice but to support consumption, right? I understand, there is a lot of skepticism as in whether China can do it. Our view is that they can definitely do some. So what are the some they can do? Yeah, is I think now there are options they were not so willing to take. They will have to take now, meaning more kind of income support to maybe still targeted population, low income population, more consumption subsidy, and probably more importantly is to speed up the development of the social security system. So if they can move concretely on these fronts, together with the stabilization of the housing sector, we can see the consumption share in the economy, finally growing again. I think this is actually quite plausible.
Wei, thank you for your insights. Wei Yao, Societe Generale. Plenty more ahead. Keep it here with us. This is Bloomberg. Welcome back. Reuters reporting that Tesla is halting its plans to ship parts from China for the Cybercab and semi-electric truck. The move could disrupt Tesla's plan to start mass production of the much-anticipated models. It's not clear how long the suspension will last. Tesla has also stopped taking new orders for the Model S and Model X as China imposes a 125% tariff on U.S. goods. Now, staying with autos, Hyundai Motors top executive expects car prices to remain relatively steady over the coming months, despite added costs from the global trade war. President and CEO Jose Munoz told us exclusively that the best way for the car maker to respond is by stepping up U.S. production.
In the case of Hyundai Motor Company, we produce in the U.S. We don't produce in Mexico, really maybe very minor, but we took a conscious decision to invest here in the USA. The rest of the production comes mainly from South Korea. Well, we are part of the Alliance for Automotive Innovation. John Bosella, the president, is representing the industry and is conveying to the government the needs that we have in the industry, which are pretty much common across the board. And then we know that there are some discussions between the South Korean government and the White House. We are not actively part of that discussion, and then obviously I cannot reveal what they talk about. But definitely we all want to ensure that there is a plain level field for everybody, so that we can compete in good terms in the market, and we want to be competitive. I maintain this message for the consumer. We will be competitive, and then the market will decide, depending on the supply and demand, if there's going to be some price increase or not. But again, we need to be competitive.
Right. So that's what I was wondering. I mean, what does competitive mean? Does that mean you're eating the costs to keep your market share, keeping your costs that consumers pay, car buyers pay, and willing to take the hit? Or, how does that dynamic work? That dynamic is not different to the way it's been done over the last 30 years or so. It's just simply, in the short term, an additional burden to manage, given all the implications of the supply. Again, our job is to focus on what we can control. The cost is something we can control. How are we responding to the increase in tariffs? Localizing, investing more in the country so that we don't get to be hit by tariffs. That's a simple solution. And then on the revenue side, we'll have to see how the market reacts. If we have the opportunity to take maybe some reduce incentives, increase price here or there, we will do. But you're not going to see like a huge increase all of a sudden, or we are not planning to remove cars from the portfolio simply because of the tariffs, etc. Again, the most important is a good product, safe product, good quality, good features, and be competitive in the market. And then the rest is our job to try to optimize through localization.
Hyundai Motors CEO Jose Munoz speaking to Bloomberg's Katie Greinfeld. In the markets, we're keeping an eye on NVIDIA's Asia suppliers on the back of new and tighter restrictions on H20 chips that NVIDIA exports to China. NVIDIA has said that it will cost it billions of dollars, $5.5 billion in terms of write-downs. In terms of how it's faring among NVIDIA suppliers in Asia, SK Hynix down more than 3%. Samsung Electronics also being weighed down right now. TSMC down 2.5% along with Advantis. Of course, this reflects an expansion in that trade war between the U.S. and China. Let's flip the page, look at where we are in terms of U.S. futures. Of course, trepidation for investors as well. Futures pointing to a lower open. S&P futures down 0.9%. That risk being reflected in where gold is trading right now. It is one of the assets that's actually trading up close to yet another record. Before we go, here's a look at our show tomorrow. We'll have fresh market analysis with Aberdeen Investments. That's as we monitor trade risks and await rate decisions from South Korea and the ECB. That is it for Insight. Keep it here with us. This is Bloomberg.